Hello and welcome again. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is Tuesday, February 13th of 2024. Today is our Market Insights and Observations video edition. We're going to go through the three topics that we believe markets are paying attention to, so you should too. So thanks for watching. So the number one topic and why markets are moving, they have been moving. S&P 500, not today. They're sort of taking a breather and off of the 52-week highs that we're seeing right now, off of the S&P 500 specifically. We did pass the 5,000 mark, and that's reason number one, which is the fourth quarter earnings are coming in ahead of expectations, well ahead of expectations. We're going to talk about that. And then we're going to talk about the earnings expectations moving forward. Those are also rising, supporting a stronger economy all the way around, and that's going to hurt the fight on inflation for the Fed. So let's get right into it. This is the S&P 500 scorecard. So what we do internally, every week, just about every day, we refresh the scorecard and basically find out our earnings expectations, our companies, how are they performing? Are they above expectations on the top and the bottom line? Or is it a bifurcation depending upon company by company? Across the board, we have over 65% of the companies in the S&P 500 that have already reported, and we're getting just close to a double-digit raise in the 9% increase in earnings, which is well above. Sometimes it's 3 to 4%, sometimes it's 5-6%. We're close to 10%, and we have 65% of the S&P 500, about 332 companies that have already reported, and that's right here. This is as of February. We got a 9% increase, but what you're going to see is this green right here. This green is every sector. There's 11 sectors in the S&P 500. Every sector is meeting and beating on the earnings growth expectations. Even if it's negative, it's still better than what was expected. So we're seeing a lot of positive. 10 out of the 11 S&P 500 minus the utilities are moving forward. So that's what's keeping the markets higher. This is also a look back, but also a look in the future as to the earnings per share progression of the S&P 500. Last year, how they started out, how they fared at the end. This year, currently 2024, the expectations, and then 2025, where we're moving to. But as of right now, let's go back. The red dot below is we finished the earnings per share about $220 for the S&P 500. Right now, it's about a guesstimation of about 443 where we're going to land. We always start off the year on the left axis. You're going to see we start off the year in January every single year of a much higher. So right now, expectations for the S&P 500 are to be in the 73, 70, so 270, 273 range, which is up here. As you saw last year, they were in the 243, and they basically worked their way down to what we're seeing is sort of a growth. So there's still growth. It's not double-digit growth, but it's about 8 to 10% growth nevertheless. And again, we're also looking for essentially just look at from 220 from last year to 243 if we get there to 275 in 2025. That's a strong economy. Those companies are actually making money, and that's what markets are paying attention to. The estimated sort of 12-month expectations on operating margins, all you need to know is in this sign right here, we're seeing that there is a sort of a directional change right now, back up, and that's a positive sign right there. Earnings expectations have been moving sideways for the S&P 7 and down for the S&P basically 493. So if you take basically the top 7 stocks, if you will, and those are all the tech companies that did so well last year, and minus the 7 stocks, you get 493 remaining S&P 500. We've had this big divergence, okay, in terms of performance. Now, the idea is that this broad-based rally broadens out, and the bottom half, if you will, that didn't participate last year. Now, granted, a lot of them went up 5, 10, 15%, but not 40%, okay? So you could still get a good rate of return by owning sort of the remaining constituents of the S&P 500, but you're just not going to get that outperformance that we're going to see. We believe that technology this year will still have a great relative performance, but not the best performance relative to everything else, because right now we're seeing sort of the broadening out. So all of the other sectors are turning the corner higher. Again, that's what we saw just in the few other slides to support this. And so this is turning back up, and the S&P 7 are still maintaining, which is really good. Not too many earnings revisions there. And a lot of technology companies are hanging in there. But the most important thing on this chart is the bottom half of the S&P 500, or large majority of S&P 500, are now playing catch up, which is really good for the markets at large. The CPI is rebounding, so Consumer Price Index, and this one is the super core, so it's less energy, rent, and primary residences. It's moving up. So this is what we're seeing today in the GDP report, the CPI report. This is negative. This is not, at the end of the day, for a growing economy, that's what you want to see. But for the Federal Reserve and what they're trying to accomplish by basically keeping rates where they need to be, but well ahead of inflation, and hopefully lowering interest rates. Again, I've been on just about every news program in the last 6 months saying the Fed's going to have to be up here and the market expectations are down here with interest rates. And so right now, this information supports the Fed still has to maintain higher for longer. I believe if you've been watching, you've heard me say that. Again, this is another indication where we're seeing inflation re-accelerating, and that's not a good thing because at the end of the day, the Federal Reserve has to stay ahead of inflation. And so if this pattern continues, it could be problematic moving forward. In any event, earnings rule the day, and earnings are continuing to sort of be the backdrop in the story as to why markets are making new highs. So keep an eye on earnings, keep an eye on inflation. Let's see how this plays out. Hopefully there's sort of noise in the data here. We got a couple more months under our belts, and so we can see expectations sort of settle out. But that's our update for today. Thanks for watching, and I appreciate it. Be sure to share, like, and subscribe, and we'll see you again next time. Take care.